In our first report on the petrodollar system, Disintegration of the Petrodollar, we covered the history behind the petrodollar. Since some time has passed, and since so many things have changed in such a short time, the petrodollar is worth revisiting. In our last report, the only unstable regime in the Middle East was Iran. Today, one could ask, what part of the Middle East isn't in turmoil at the moment? How many of these countries still view the U.S. favorably? How many of these countries even have a stable government that we can work with? These widespread changes have set the stage for the end of the petrodollar. As you may recall, these Middle East oil-producing countries agreed to use the petrodollar in exchange for the U.S. providing military defense and stabilizing the region. I think we can agree that the region is anything but stable, and these countries have found themselves having to get involved in military actions against each other. If they're going to have to provide their own military defense, what's the incentive to continue to use the petrodollar, especially when there's already been pressure to abandon it? Iran is not part of the petrodollar system. So far, sanctions have kept Iran from being a major supplier of oil. Unfortunately, the current administration's negotiations with Iran over their nuclear ambitions have, as their underlying theme, the removal of these sanctions. Whether or not Iran abides by the terms of any nuclear agreement, the removal of sanctions is a foregone conclusion at some point. When that happens, the Iranian economy will take off, and the Iran Mercantile Exchange will become an international exchange, trading large volumes in currencies other than U.S. dollars. It's been widely speculated that Russia and China would try to destabilize the dollar by working to eliminate the petrodollar. As it turns out, they didn't have to. The Federal Reserve's manipulation of the dollar, coupled with other countries having their own economic challenges, resulted in a stronger dollar. This removes some of the incentive to move away from the dollar. In addition, Saudi Arabia seems to have purposely created the glut in oil and the resulting decline in prices worldwide. It was generally thought that this was done to crush the Russian economy by driving the cost of oil below the Russians' production costs. This was thought to be a way to get back at Putin for supporting Iran, a country that Saudi Arabia sees as a threat. In fairness, it might have also been designed to put the brakes on the expanding shale oil production in the U.S. Whatever the reason, the international sanctions placed on Russia, combined with their loss of oil revenue, has resulted in a weaker Russian economy. In the past, Putin used his petrodollar surplus to stabilize their economy. However, according to Russia's central bank, their petrodollar surplus will be depleted in early 2015. Whatever incentive they had to protect the petrodollar will be gone at that point. While it creates jobs and spurs the economy, it puts pressure on our fragile relationships with the very people who we're asking to support the petrodollar. What incentive do any of the petroleum exporting countries have to continue to sell their oil in U.S. dollars when we're competing against them and forcing prices down? The good news is that the shale oil industry has kept the U.S. economy from getting worse. The bad news is that shale oil production is dropping in the U.S. due to poor profitability at the current prices. As a result, shale oil may not be able to prop up the economy much longer. With oil trading at roughly half of what it used to, the amount of money pouring into the oil-producing countries has dropped dramatically. With a need to fund their own domestic agendas in the face of declining revenue, many of these countries are no longer recycling those petrodollars into U.S. banks or other dollar-denominated assets. As Bloomberg reported, if oil and other commodity prices remain depressed, the trend will cut demand for everything, from European government debt to U.S. real estate, as producing nations seek to fill holes in their domestic budgets. BNP Paribas has further confirmed that in 2014, for the first time in 18 years, petrodollar exports were negative. You may have noticed that our economy isn't exactly humming along. Is anyone happy with a sub 1% rate of return on their money? How about having only 63% of the working age public actually working? Neither are very encouraging, and the problem is that our government really only has four ways to solve our economic problems: raising taxes, cutting spending by reducing benefits, borrowing money through the issuance of bonds, and printing money. Conventional wisdom identifies the first two as political suicide. Naturally, the producing part of the country, the 53% who actually pay taxes, wants taxes reduced. That's not surprising, since they're basically carrying those people who don't pay any taxes. Conversely, the famous 47% of those that don't pay taxes are generally the ones that are also utilizing government benefit programs. Naturally, they don't want benefits cut, and in many cases, they're looking for an increase in benefits. With roughly half of the country in each camp, choosing either group alienates the other half. Not a winning strategy if you're a political animal focused on re-election. So realistically, we're left with only the last two options. The problem with the third option, issuing bonds, is that according to government records, since 2008, foreign countries have been purchasing less than half of the Treasury bonds issued, largely due to the increase in issuances. So who's buying all these Treasury bonds? More and more, it's the Federal Reserve that's buying our own bonds. The worst part is how they're paying for them. You guessed it, they're using the fourth option and printing money. Adding to our economic woes, the exploding welfare state is growing faster than anything else in our economy, with the possible exception of the jobless rate. It's widely reported that 1/3 of our population is receiving a government check of some kind. Add the warfare state, where we seem to be in a never-ending cascade of military conflicts, which, in addition to the human cost, is financially crushing. Along with the increasing number of conflicts comes the increasing costs of medical, disability, and other military benefits. While it fluctuates, in recent years, the U.S. government has shown the military's budget to be around 1/3 of our national budget. That seems high until you realize the military has pegged half of it for military pensions and medical benefits. If that's true, then 1/6 of the U.S. budget would appear to be going to military benefits. As we get involved in more conflicts, we're essentially buying an increase in future military benefits. If the history of military activity in the Middle East has, in fact, been about controlling oil, can we ever expect to see a reduction in military activity in that region? Prevailing wisdom says no, not if we want them to continue to support the petrodollar. Effectively, the petrodollar has already died. With oil selling below half of what it used to, the amount of petrodollars being created was already cut in half. With the oil-producing countries no longer investing those petrodollars in other dollar-denominated assets, the petrodollar cycle has, for all intents and purposes, ended. Zero Hedge has reported that a major U.S. bank's interviews with several in-house economists turned up the following. The end of the petrodollar recycling chain is said to impact everything from Russian geopolitics to global capital market liquidity to safe haven demand for treasuries to social tensions in developing nations to the Fed's exit strategy. So the end of the petrodollar is going to affect a lot more than just our economy. It's going to create all kinds of other unintended consequences around the world. But back to our immediate problem. Without the petrodollar propping up the U.S. dollar, our dollar has to stand on its own for the first time since World War II. How can it do that with a fluttering economy and our government running the printing press day and night? How long until the dollar reflects this new reality by taking a big hit and dropping drastically in value? When the oil-producing countries no longer invest in foreign currencies, real estate, and other traditional investments, those assets will drop in value too, as the supply exceeds the demand for them. So, if traditionally safe investments are now suspect, where do we go? In situations like this, assets that are less volatile and can't be created out of thin air make more sense. Scarcity and demand create value. Running the government printing press does not. If you're concerned about this and you'd like to read our report on wealth, preservation, and prosperity, it's available now at sbcgold.com. Global abandonment of the petrodollar. Check. Increased turmoil in the Persian Gulf. Check. A banking system fraught with trillions in risk-laden derivatives. Still there. $18+ trillion in government debt. Still there. $200+ trillion when you include entitlement programs. Still there.